Hello and welcome to MF Corner. I'm Sonal Bhutra, and with me as always is Vinnii Motiwala. And there's a lot that's happening in global markets. We are seeing some developments with China. There's so much happening on AI, tech. That's all we are going to discuss today.
Absolutely. That's what we'll be discussing today, especially coming in on China front, where, we've seen that run-up coming in the last 1 year. Funds which are there or invested in China, they've seen a very good move as well. Now, does this move actually warrant for someone to invest in further? That is something that we'll be keeping an eye out on. And that's what we're going to be discussing today. For that, we have Roongta, CFP at Roongta Securities joining in with us, and also with him we do have Kirtan Shah as well, founder and CEO at Truvanta Wealth. Kirtan as well as Harshvardhan, thank you so much for joining in with us. Let's start with talking about China first. Now, the rally that we've seen in the last year, what does it indicate in terms of the move that we should be watching out for? Does this merit that one should actually look at funds which are investing in China, or should you just look at more international funds? Kirtan, let's start with you.
I think like you rightly started, the entire conversation is because over the last 1 year, China has given some 40-odd% returns. And this is not very normal of China, because if you look at the last 5 years, the same return, in spite of the last 1 year being 40%, the 5-year CAGR is just 3%, right? Now, the problem with China actually is not really the economic development, because if you look at the last 15 years, you will see that probably the GDP has grown 3x, the per capita income in dollar terms has grown 3x, but the stock market return is close to savings bank account return, right? Versus that, if you look at India, India has grown only at 2x on GDP as well as per capita. But we've done a good 12-13% CAGR over the last 15 years. So I think the problem with China really is not the economic growth. It is more to do with the political crisis that China goes through. And because of which the return on capital employed is really bad. And hence investing in China is more of a political crisis than really a stock marketing investment.
Oh, okay. So, Harshvardhan, do you have something to add to that? Is it largely political? What about the GDP growth and the other aspects of economy as well? And if you agree with him or disagree with him, do you think an Indian mutual fund investor consider diversifying into such funds? What would the potential benefits be?
So, hi, Sonal. So, in fact, I concur with Kirtan in terms of the numbers that we're speaking about. Now, if you look at the economy that we're talking about, as Indians, your question was very specifically saying that do we look at investing internationally, particularly China? So my view is that as Indians, we're very fortunate that we are in one of the fastest growing economies in the emerging markets, at least. So if I were to take an exposure into an emerging market, what better place would I have than to invest into India itself? Now, with regards to investing overseas, now, there are primarily 2 or 3 reasons why we would look at parking certain portion of our money into international markets. Now, one, of course, will be the geographic diversification. I mean, we will have a large portion of our investments in India, but there has to be some portion that we will diversify geographically into other countries and in other economies. The other reason that you would invest in internationally would be because there could be certain sectors, certain companies, certain themes which are not listed in the domestic market. In India, for example, we would not have much or any options which invest into space technology, for example. So you would have these kind of options available in other markets overseas and globally. The third reason that you would want to take exposure would be for dollar exposure or hedge against rupee depreciation. Now, this particularly is applicable for people who would foresee some kind of expenditure in the future for their children's education overseas. So they may want to have some investments wherein they hedge against the rupee depreciation. Now, let me take the first and the second element that I said was geographical diversification. So if you look at India as an emerging market, one of the fastest growing emerging markets with the returns commensurating in the returns that you get on your capital invested, then if you're looking to invest somewhere else, why wouldn't you look at a developed market like a US or probably some other developed markets globally? And in terms of innovation, some of the best companies that you will see in the tech space as well would be domiciled in US, for that matter, having global exposure. So I think all in all, there could be better opportunities available for Indian investors.
Absolutely, better opportunities maybe there in the developed market. But, if Kirtan, someone still wants to look at it, right, and still wants to look at China-focused funds, what are the factors that one should actually be careful, aware of before you start investing here?
I think I'll go back to the same example that I gave you. If you look at China currently, it's trailing at 12 to 14 times. And it is way below historical averages from a global peer standpoint. Now, this probably is pricing in that there is some political problem, and which is why the valuations in terms of China is probably cheaper than what the global average is. So, if I can give you some examples of why am I, again talking about political problems and crises, you would see a series of short selling ban in China, which is a very common occurrence. You look at 2021, the ed tech business was cracked down because they put some restrictions saying that education companies cannot profit. And there were some stocks which fell 90%. You probably look at the tech sector regulation and you will know that, players like the Alibaba or the Transcend have faced trust fines and restrictions. You also look at companies like Didi, right? They were forced to convert their existing contractual drivers into salaried employees, which again created a big problem for organizations which were running on contractual basis. You look at the gaming restrictions that came about, where minors were restricted for the screen time. That impacted the valuations of gaming company big time. So while you are investing in China, like I said, it's really not about how the economy is doing, because the economy is doing very well. The problem is that when you are, as an investor, trying to allocate capital, are you going to make monies on the capital? And that largely depends on how the political scenario plays out and which sector it ends up impacting. So while you are investing in equities, you probably will want to take a bottom-up approach where you're looking at companies which probably you think are going to do well and hence invest in them. But one change from a political standpoint and that entire sector, in spite of doing very well, your capital will not make money because the political situation will not allow you to do that. So I think even if, in spite of this, somebody really wants to make investments, I think the only real thing that you want to look at from a China standpoint is whether or not is there political stability, which is not really impacting stock market. I think that's one very important data point that you would want to look at, because economically, right, or performance from a company or a sector standpoint, I don't really think there is problem, because there are a lot of sectors in China which you can really look at investing, specifically from an AI, EV, or even an e-commerce space. But the problem is that tomorrow, if the government comes out with some regulation in that space, that will end up impacting your investment.
All right. Harshvardhan, what's your take on this? What factors should anybody consider before investing in China-focused funds, and say China-focused funds versus other international funds? How should the investors allocate their mutual fund and invest in international market in that case?
So, well, Sonal, the technical aspect has already been discussed about. So now what we're talking about is that if you are looking to invest into a specific country, okay, we're not looking at a geography particularly, we are saying that it is a country that we are investing into. It's very important that you start, following the developments in the political and the economic circuits that we're talking about right now. So if I were an investor looking to put money into China, I should ask myself a couple of questions. Am I going to be able to track the developments in the economy very closely? So in most cases, we are only reacting to the information that has already been in the public domain, whereas the action has already taken place in the economic, in the stock market. For example, all that we get to know that has happened in China is after it has happened. So as an investor sitting in India, do I have the potential to take that call and to monitor the development so that I can take action as and when it happens, or maybe before some development is going to happen? Now, if I don't have that capability, of course, I will need to keep in mind that I would need to choose a fund which is able to do so. Now, hypothetically, I choose a fund which is actively managed, and then I need to go into the companies that that portfolio is holding. So if I pick an active fund manager, I pick the portfolio, and I start looking into the companies that they've invested into. I should have the wherewithal to make the difference. I mean, to understand what they're investing into and how are those companies likely to be impacted. If I still want to invest into China and I don't want to get into these finer details, I have a choice to pick the index there. So, which could be the Hang Seng, for example. You could just pick an index and invest into it. And sitting here back in India, you could just track what is happening to the index, and you know what's happening to your investments. So, so sum up what you asked for. The point is very simple. if you have the wherewithal and the technical know-how of which companies to invest into, which fund manager is doing what exactly, then you may pick an active fund. If not, then it's better to pick an index for that matter. Further still, I mean, if you, as I started with saying that emerging markets, India it's a place that you already are in. So might as well look into other countries such as the US, which are more, which are more diverse in that in kind of nature. The companies may be domiciled in US, but they would have their business operations across the globe. So in that sense, you would still have a global exposure with companies domiciled in the US.
Okay. Kirtan, just a quick one. Are there options that are available, right? Which mutual funds are available right now for these China-related funds or China-focused funds are there?
So, Vinnii, if you leave aside the ETFs that Harsh was talking about, from an active standpoint, there are two popular funds that you can look at if at all China active investing is what you all are looking at. One is Axis Greater China Equity FOF, and another is Edelweiss Greater China Equity FOF. So these are funds which actually end up investing in an active fund which is based out of somewhere. But you can do this active investing, or if active investing is something that you look at, these are two funds that you can look at for China.
All right, we take that point. This is about investing in Chinese markets via mutual funds. But before now, we have to take a quick break. We'll focus on investing in tech and AI on the other side of the show. Stay tuned for that.
Welcome back to MF Corner on CNBC TV 18. Now we're going to be discussing investing in tech and AI funds. How does that look like for the Indian investor? What are the options available as well? We still have with us Harshvardhan Roongta as well as Kirtan Shah. Harshvardhan, let's start with you this time, right? Now, we've seen that AI, the boom that has come in the last year as well. What is an option that is available right now? Is there an option available for Indian investors, mutual fund investors to invest in AI-related funds or maybe tech-related stories that we want to watch out for?
So, Vinnii, let me give you an analogy with regards to how should you capture the boom in any story, a boom story that we're talking about. So, whenever there's a trend in the consumer behavior or there is an economical shift in certain sectors or segments, we need to be very careful that every boom story does not mean it's a great investment opportunity. Let me highlight this with an example. So while we would notice now that most Indians are spending on holidays, we're traveling more by air and not by train. So train journeys vis-a-vis air travel, we're seeing the number of passengers going up. Now, does this automatically mean that airlines are the business to invest into? Well, it need not necessarily mean so. Why? Because you will see most of the airlines still struggling to make profits. Similarly, if you look at the EV story, now, we know that EV vehicles is the future from here. I mean, you're going to have, alternative sources, alternative fuels in which we will have to run our vehicles. So EV looks to be the most promising next boom story that we're looking at. But we will have to be very careful in understanding which stakeholders in the entire ecosystem will make money. Is it going to be the EV manufacturers? Is it going to be the charging infrastructure companies? Or is it going to be electricity generation companies? So we don't know who's going to make money into this entire boom story. So while we understand that AI tech is going to be the next future, it's very important to understand who's going to make money in this sector. Does not everything that is going to be the flavor of or economical shift in the future does not mean the participants will make money on it. So having said this, we are at a juncture where yes, tech is going to play a major role, and AI particularly. Now, for an investor, again, coming back, if you're investing into any sector or theme for that matter, you have to be knowledgeable enough to time your entry and exit. So if you're investing into AI boom, for example, or you're investing into tech, you need to be very mindful that you should be able to track and monitor that particular sector so that you can time your entry and exit. So if you just enter into something and that sector comes into some kind of a turbulent time because of some regulatory changes, you need to time yourself to get out of it. So, well, I do agree with you that this is going to be some sector to look out for. But frankly, which company is going to take the lead in this, at least domestically? We're talking about the domestic market in India. Which company is going to be able to take the lead in this, make money out of this, remains a question. At least I am personally not able to track that on a day-to-day basis. So for all such cases, I would suggest for a retail layman investor, a diversified mutual fund works best.
What about you, Kirtan? What do you suggest when it comes to investing in tech and AI? Is it direct tech stocks or diversified equity funds? And if yes, what percentage of the portfolio should be allocated to this particular sector?
I think, Sonal, I completely concur with Harsh on this that, as a retail investor, you probably might want to leave that decision to the fund manager by investing in a diversified fund. But let's say, for example, if there is a sophisticated investor who can actually time entry and exit in a particular sector, and if we can break India investing and global investing separately, in India, probably what is happening in the tech space, which is largely services today, is we know that AI is changing it so quickly that Indian services companies are not able to cope up, and which is why we see the layoffs and all. And we've already seen that in the price, right? So probably the fallen down tech sector in India for sophisticated investor may be a great opportunity to, kind of gradually start allocating money, because most of these companies are tech rich, and probably if R&D is done well or acquisition is done well, tech will turn out to be, a good sector to look forward for the current price or value it is available at. But this is only for sophisticated investors, and retail, I will concur, is not really the audience who should really look at doing something. Now, if I talk about global investing, I think to answer your question, I would sincerely suggest investors to look at investing in the index and not to invest in particular stocks. And I'll tell you why. If you go back to 2020-21, the entire energy sector was probably 2-3% of the index, which is S&P 500. And at the same time, Nvidia was 2-3% of S&P 500.
Yeah.
Today, Nvidia is probably 3 times of the entire energy sector. Nvidia is at 8% and the energy sector is at 2-3%. In fact, the last 1 year, total return of S&P 500, 20% of that total return was only Nvidia. Right. So the point that I'm trying to make is that if you try and pick individual stocks and you don't get it correct, you probably might lose out on a great opportunity that you could have made when the overall sector ended up doing well. Now, what is happening is, if you look at probably S&P 500 and you look at the last, let's say, 5 years of data, you will see that 30-35% of S&P 500 is actually the Magnificent Seven. But in spite of 30-35%, which is a significant weight to 7 stocks in a particular sector, these stocks have been innovating and growing at a very fast pace, right?
True.
Because of which 51% of the total return that the S&P 500 generated was generated by these 7 stocks alone. So to answer your question, I would suggest that instead of picking stocks, you should actually end up picking indexes that you want to invest in if you want to play this thing. NASDAQ will be a great opportunity. But for retail investors, they might want to stick to more diversified fund, but sophisticated investors can take this bet depending on what their understanding and risk profile is. But I don't think you should have more than 10-15% allocation on a very high side to a particular sector, which includes your equity diversified funds having exposure to tech, plus your global diversification, which may include probably NASDAQ.
Okay. Can look at diversified funds if you all want to look at. That would be a better option that both Harsh as well as Kirtan have said. Harsh, just a quick one. What is the allocation you would suggest as well? 10-15% as well? Nothing more than that, right?
Yeah, so in terms of global diversification you're talking, so it could be 10-20%. Now, depending, of course, if there is an individual who foresees future expenses in dollar terms, for children's higher education for that matter, could look at allocating a little more purely for the sake that you need a dollar exposure. But in terms of geographical diversification, anything between 10-2%, 20% is a fair amount to allocate towards international equities.
Okay, 10-20%. Keep it out in that range only for global diversification. But Harsh as well as Kirtan, thank you so much for joining us. We're absolutely out of our time on this edition of MF Corner. So thanks for giving us those details in terms of tech and AI funds, as well as in terms of China fund, whether you should look at investing. With that, it's a goodbye from Sonal, myself as well as the team who put this show together. Don't go anywhere. You have closing bell up next.